NYAX beat consensus on top-line revenue this quarter, hitting $122.6 million, and they cleared adjusted EPS.
Yeah.
But they missed badly on GAAP EPS.
Yeah, a $10.1 million net loss.
Right. I mean, the revenue was up 28.2% year over year. Organic growth was 21.4%. So they easily beat that $116.75 million street estimate.
They did. And adjusted EPS came in at 14 cents, beating the 9-cent estimate. But the GAAP loss...
The GAAP loss was a shock.
It was. And then management reaffirmed their full year 2026 revenue guidance of $510 to $520 million and adjusted EBITDA of $85 to $90 million.
But then they just took a hatchet to their free cash flow conversion.
Right. Slashed it from roughly 40% all the way down to just 5 to 10% of adjusted EBITDA.
Which is, I mean, the market absolutely punished that cash flow revision.
Oh, instantly. Shares fell roughly 10% post-earnings.
Yeah, dropping from the $69 range down to around $62.
And if you're looking at some of the overseas listings, depending on the currency, it showed a proportional drop to around 18.66.
Right. So, in this deep dive, we're going to break down how this underlying segment performance is actually driving that top-line beat.
Because the top line is growing fast.
Exactly. But we also have to look at the margin compression, the compensation issues causing that net loss, and management's really aggressive pivot into banking.
Not to mention the notable risks that are totally weighing on the stock right now.
Right. So let's start with the revenue engine. The top-line beat was solid. What exactly is driving 28% growth here?
Well, it comes down to how their installed hardware is basically fueling their recurring software revenue.
Right.
Like if you look at recurring revenue, so that's SaaS and payment processing, that is the core of the business. That grew 24% to $87.7 million.
Which makes up, what, 72% of total sales?
Exactly, 72%. But meanwhile, point of sale, the POS device revenue, that jumped a massive 40.2% to $34.9 million.
Wow, a 40% jump in hardware.
Yeah, and their network scale is it's huge now. The installed base hit 1.55 million connected devices.
Over 1.5 million devices? That's wild.
And their customers grew nearly 20% to over 125,000.
Which explains why the transaction volume is through the roof.
Yeah.
I mean, total transaction value spiked 29% to $2.1 billion.
Right, across 815 million processed transactions.
And average revenue per unit, ARPU, climbed 13% to $251.
Yeah, so existing customers are spending more.
It really reminds me of the classic razor and blades analogy.
Oh, for sure.
Like selling the hardware, the POS device, is just selling the cheap razor.
Right. You just want it in their hands.
Exactly. They just want to sell the high-margin blades, which, is the recurring saws and transaction fees.
Yeah. Every new terminal deployed is a permanent touch point. It just compounds that high-margin revenue stream.
Because once a merchant puts a NYAX reader on a vending machine, they're not taking it off.
Never. The net revenue retention historically hovers around 120%.
Right. So if that flywheel is spinning so fast and recurring revenue is up, why did they report a $10.1 million GAAP net loss?
Wow.
I mean, they had an $11.7 million profit a year ago.
Yeah, it's a massive swing. And the biggest culprit there is stock-based compensation.
Okay, how big of a jump are we talking?
It surged to $12.4 million.
Wow.
Yeah, up from just $2.5 million a year ago.
That is a huge jump. What drove that?
They implemented this new 5-year, they call it the Diamond Plan for senior leadership.
Got it. So trying to lock in the executives.
Right. But it hits the GAAP numbers hard, and then you have the margin divergence.
Right. Because overall, gross margin fell to 46.9%, down from 48.3%.
Yeah, but you have to look under the hood there. Recurring margin actually improved.
Oh, really?
Yeah, it went up to 54.3%. The real drag was the hardware margin.
Let me guess, it plummeted.
Plummeted to 28.1%.
Ouch. 28.1% on hardware.
Yeah. And the reason for that is product mix, specifically the Linkwell EV charging platform.
Ah, the EV chargers.
Right. 65% of their hardware revenue growth came from Linkwell.
Okay, but why does that drag the margin down so much?
Because EV chargers have much lower margins than their traditional, VPOS products.
Oh, sure. I mean, a card reader is just a small plastic device.
Exactly. An EV charger is heavy industrial equipment, and you have to compound that with higher freight and logistics costs.
Right. Shipping a fast charger is not cheap.
Not at all.
But let me push back on the market's reaction to that.
Okay.
If hardware is basically just a customer acquisition tool, right? Like we said, a Trojan horse to lock in highly profitable sticky sauce revenue.
Yeah.
Shouldn't retail investors actually cheer a massive 40% spike in hardware deployments, even if it hurts margins today?
I mean, management would completely agree with you. They don't see lower hardware margins as a failure at all.
They see it as an investment.
Exactly. They see it as necessary investments for a massive strategic pivot.
Right. Which brings us to the bank charter.
Yes. They filed an application with the Connecticut Department of Banking for an innovation bank charter.
To become NYAX America Bank.
Right. And if approved, which, they expect to be operational in 2027, it lets them bypass this whole patchwork of state licenses.
So they can offer embedded financial services directly.
Directly to the merchants.
And they're already moving in that direction with NYAX Capital, right?
Yeah, they're bringing lending and card issuing fully in-house.
They launched that yellow account for U.S. customers.
Exactly. Where merchants can just hold their balances and use linked debit cards.
It really is a Trojan horse. They sneak into a small business with a simple card reader for a laundromat, and then boom, they become the merchant's lender, bank, and loyalty program.
Yeah, and the underwriting advantage there is insane.
Because they see the data.
Right. Management emphasized this. They see the merchant's settlement data every single day on their own platform.
So they know exactly how much cash flow that business has.
Exactly. So they can underwrite loans with way lower risk and then collect automatically from the daily settlement flows.
That's brilliant. Before the merchant even sees the money, NYAX takes their loan repayment.
Right. But it requires capital. Especially with the EV expansion, they're deploying Linkwell DC fast chargers at double the pre-acquisition pace.
Double?
Yeah, intentionally running hot to capture market share.
Okay, but transforming from a payment processor into a regulated bank and a major EV infrastructure player that is highly capital intensive.
Extremely.
Which brings us to the primary risks currently spooking the market and driving that 10% sell-off.
Yeah, the cash flow burn is the elephant in the room.
Right, because Q2 free cash flow was negative $13.1 million.
And then the severe cut to the free cash flow conversion guidance, down to just 5 to 10% of adjusted EBITDA. The street hates cash burn.
They really do. And then there are the M&A costs.
Yeah, the recent Brazil acquisition, VM Tecnologia.
Right, they had to do an amendment there.
They did. They replaced contingent payouts with a fixed cash payment.
Of 35 million Brazilian real.
Right, which is roughly 6.8 million US dollars.
And that triggers a $4.5 million accelerated expense in Q3, doesn't it?
It does. It's an immediate hit.
Plus, they had that cybersecurity incident.
Yeah, they disclosed a data exfiltration cyber attack during the quarter.
No, they refused extortion, right?
They did, and operations continued, but it adds a huge layer of headline risk.
Especially if you're trying to convince people you should be their bank.
Exactly. Trust is everything, and despite the drop in the stock price, NYAX still trades at a massive trailing PE ratio.
What is it, around 244 times?
Yeah, Prex 244x. The market is basically pricing in perfection for their 2028 targets.
Which are, what, $1 billion in revenue?
$1 billion in revenue and a 30% adjusted EBITDA margin.
You know, I have to question the defense management gave on this.
The timing issue, defense?
Yeah. Management claims the cash flow revision is just a matter of timing for investments. But is building a bank and subsidizing EV chargers truly a short-term timing issue?
Right.
Or is this a structural shift toward a more capital-heavy business model? Because to me, it feels structural.
It's a fair question. The market is clearly worried it's the latter. Operating a bank and building physical infrastructure is fundamentally different than selling saws.
Exactly. It completely changes their corporate identity. So as you look at all this, you really have to wonder about NYAX's identity crisis.
Yeah.
They are actively choosing to abandon the safety of being a pure-play, capital-light sauce payments company.
To enter a highly regulated, capital-intensive world.
Right. Banking and EV infrastructure.
Yeah.
So will the market reward them with a massive fintech premium for owning the entire merchant financial stack?
Or will they be continually punished for the heavy cash burn required to get there?
Exactly. Because if that $1 billion revenue target for 2028 doesn't come with strong cash generation...
Will the top-line growth even matter?
Right. Will it even matter? It's something you definitely need to watch closely. Be sure to follow this show for daily, no-nonsense earnings coverage that cuts straight through the noise.